Hello class, this is Demetrius Wilson again. Welcome to week 5 and chapter 5. How do organizations identify cost behavior patterns? Got a good tip from one of the students. I've moved my screen with my face and image and everything up to the upper right hand corner, and I looked through the PowerPoint, so it shouldn't cut off anything except for one header on one slide and make it a lot easier for you guys just to see some of the numbers. Don't want to cut those off. Definitely want you guys to see the numbers in the lecture. So chapter 5, how do organizations identify cost behavior patterns? All right, so identify typical cost behavior patterns. So why must managers understand how costs behave with changes in sales volumes? Well, it's all about decision making. Everything that we do in managerial accounting goes back to decision making. I need to know if I make 100,000 widgets and everything's great. If I make 200,000 widgets, is everything still going to be great? Or do I have to open up a new facility, hire new sales managers and new salespeople? So these are things that you have to think about. So to predict what will happen to profit in the future, right? And so in order to predict what happens to profit, we have to definitely have a good grasp on what happens to our costs. Because if our profit is great from producing 100,000 widgets in building A, but then now we have building B, we're going to probably spend just as much for building B as building A, and it's going to cut into our profits. There are three different cost behavior patterns. Variable cost, right? So a variable cost is a cost that it's going to change in regards to the amount of activity that you have. So if I have a bike and it costs me $10 to make each bike, and I make 10 bikes, then it's going to cost me $100. But if I only make one bike and it costs me $10 to make each bike, then it's only going to cost me $10. And then that's when we roll into fixed costs, which is the second one. And a fixed cost is a cost that's there no matter what. So if the facility in which I make those bikes at costs $10,000 a month, then I'm going to pay that $10,000. Whether I make one bike or 50 bikes or 1,000 bikes, I'm still going to pay that $10,000. My costs in regards to fixed costs remain constant. Same thing typically when we're talking about a lot of the salary issues. And then we have mixed costs. And they'll give some good examples in the book, but a good example, in my yesteryear, I was in the sales profession, and we had what you call a draw. So the salesperson got $1,000 for the month, and then let's just say every copier they sold, they got $100. So I got $1,000 plus $100 for every copier that I sold. So if I sold 10 copiers and I got $100 for that, right? Then that means I have an extra $1,000. So now I have $2,000, 1,000 for my draw that I get no matter what, and then $10 per copier. I sold 10, 10 times 10. I'm sorry, $100 per copier. I sold 10, 10 times that $100 is another 1,000, $2,000 that I make. And so it'll give some examples about those mixed costs. So what is variable cost? So cost that varies in total with changes in volume of activity. Most common variable costs are direct materials and direct labor, right? Because those things vary. It varies on how much material that we need to requisition in order to make these bikes. It varies in how much labor we need in order to make these bikes. Maybe we make more bikes during the summer because more people are out riding their bikes. Maybe we make more blankets in the winter because more people are cold. Total variable costs change with changes in activity, but per unit, a variable cost remains the same with changes in activity. And I'll explain that second comment shortly. So if you look at our chart here, always good to have visuals and charts. There's an example of a variable cost at Bikes Unlimited. So you see that you have these data points, right? So that data point right there, if you see in the middle, it's probably about 1,000, right? So at a 1,000 bikes, it's going to cost $50,000, right, for the total variable cost. And at 2,000, that's in between those two. Let's just say that's 125,000. All just estimates when you're charting a graph, unless you have data plots, which is at the very end of the chapter. We're going to talk about regression analysis that you can. I'll probably have you guys do if you want to for an extra credit assignment if you need it, doing a regression analysis through Excel. Really easy, just have to follow instructions. So what is fixed costs? Costs that do not vary in total with changes in volume of activity. Examples of fixed costs include salaried personnel, right? Salaries, can't get rid of that. You pay them salary. You don't pay them hourly. And even if you pay the people hourly, just think about it. They're going to work 40 hours a week, right? It's not like they're going to work 30 hours a week, 40 hours a week, 20 hours a week. They're going to work 40 hours a week. So a lot of times that salary will be considered under fixed costs, even if it's not the salaried people. It could be the non-exempt people that get paid hourly. But salaried personnel, they're always going to be there and they're going to be paid. Building rent, right? You're building. If you can't go to the landlord and say, hey, you know what, I only sold one bike this month. Can you give me a break on my lease? No. Whether you sell one bike or 50 bikes, it's still going to cost $1,000 because you're not going to go to him and say, I sold 100,000 bikes this month. Let me give you extra rent. Are you? Just think about it. And insurance, right? You're going to have your insurance no matter what. So total fixed costs do not change with changes in activity, but per unit fixed cost does change with change in activity. And that's the same thing, that second statement. Don't get confused by it. Kind of ignore it for now till I go further into the lecture. So example of fixed cost is bikes unlimited, right? You see here's the fixed cost line and it's $20,000, right? It's always going to be $20,000 because whether we make 2,000, 4,000, 6,000, 8,000, it's going to be $20,000. Now, when you get outside of that, maybe it's not going to be $20,000 is when you get outside the relevant range. And that means that a certain, constants have to change, like a constant that would change that I need a new building, I need to hire new people, then maybe some of your fixed costs can actually change. So what is the difference between a committed fixed cost and a discretionary fixed cost, right? Well, one, we have to stick with you. We're committed to you, right? To death do us part. And a discretionary, well, not as serious as death do us part, but discretionary, if times get tough, and I'm gonna give you guys some real world example, then we do not have to use money for these things. So committed fixed costs cannot easily be changed in the short run without having a significant impact on the organization. So here's a good example. A long-term building lease, right? You can't just break your lease, right? There's going to be a fine if you do, right? You're going to have to pay out some extra money. Salaried employees with long-term contracts, they have these contracts just like in sports. It's a committed cost. You're committed to them, and sometimes you're going to end up like looking at the New York Knicks right now. They're considering and mulling over buying Amari Stoudemire out of his contract. So even though you're still going to have to pay you and give you some money, we just don't want you here because you don't fit in terms of what we're trying to do as a team. And depreciation on buildings as well. So these are committed costs. There's committed fixed costs. There's nothing that you can typically do without there being a penalty or a fine. So discretionary fixed costs can be changed in the short run without having a significant impact on the organization. So some examples are charitable contributions, advertising, research and development, and training programs, right? So these things are the first to go. I'll tell you from my experience, especially in job wise, people in the training department, things get tough. A lot of times they're the first to go. Charitable contributions, hey, this is it's not a priority for our business. We're giving money, and times are tough for us, so we have to tighten up the reins. We can't give to charitable organizations. So I know places like the United Way, I know they struggle during the time when the economy's down. Advertising, we're not going to advertise as much. And research and development, we have enough products. Hopefully, we'll bounce back, and then we'll get back to research and development in the near future. So many would argue that reducing spending on these areas could significantly impact the organization. Determining discretionary fixed costs is not a perfect science. Of course, you have to have some judgment and also some luck in regards to that. I used to work for this company and thought they were going to get a big contract, didn't get the contract, and then they said, you know what? All these things like the Christmas party, all these events that we do, we're going to have to cease fire on these things for right now until we get our financials in order. So what is a mixed cost? Well, it's just a mix between fixed costs and variable costs. Cost that is a mix of fixed and variable costs. Examples: compensation for a salesperson, kind of like the example I gave earlier. That includes a monthly salary and a commission based on number of units sold. That monthly salary it's what you call a draw in the sales environment. Mixed costs change with changes in activity, and per unit mixed costs also changes in the changes of activity. So there's an equation that we're going to use for this chapter. So what is the equation used to describe mixed costs? So total mixed costs, right? So that total mixed cost is going to be that capital Y, or the big Y on the left side, equals total fixed costs, which is the lowercase f, plus the unit variable cost, which is the V, right? So remember the little V for variable, times number of units, right? So however many units we have. And when we get this equation and we have it for whatever, for bikes, tables, computers, whatever, then we just simply put the number of units in the equation, and then we come out with our number every time. So this is how it's utilized. So y equals f plus vx. Write that down somewhere. You'll definitely need it. Where y, capital Y, equals total mixed costs, right? Lowercase f equals total fixed costs, and v, lowercase v, is variable cost per unit, and x is the level of activity. How many bikes, how many tables, how many this, how many that. So what is a short-term decision-making assumption, and why is it so important? Well, it's important because most of these things are geared towards short-term decision-making. Long-term decision-making, you can't focus on that with this because those things, the variables change by the time you get to long-term. So we're focusing on the short-term decisions. So what is short-term decision-making assumption, and why is it important? So when identifying cost behavior patterns, we assume that management is using the cost information to make short-term decisions, right? So we assume, as they say, you shouldn't assume, but we do assume that, and if they're not, they're making a mistake. The short-term period will vary depending on the company's current production capacity and the time required to change capacity. Sometimes companies aren't as liquid or as fluid in the changes that they make throughout. And in the long term, all cost behavior patterns will likely change, and that's definitely true. So what is meant by the term relevant range, right? So relevant within a certain specific range, and why is it important? The relevant range is the range of activity for which cost behavior patterns are likely to be accurate. So during or within this range, variable costs should be this and fixed costs should be this, right? Now it's not a super duper exact 100% thousand, to the T science. These are estimates, but it should be within that relevant range. Now, when you get outside that relevant range, that's when you have to start making different calculations and decisions. So the variable, fixed, and mixed costs for a company will only be accurate within this range, right? So these figures will not be accurate outside of this range. If we go outside the relevant range, cost estimates must be reevaluated. More work for the managerial accountants and recalculated. How are cost behavior patterns used by managers? The best way to accurately predict costs is to understand how costs behave with changes in activity, right? How do the variable costs change in terms of change in activity, and how might the fixed costs change as well? This allows managers to answer questions such as, and these are definitely questions that managers, like managers within the customer service, claims, production, procurement departments would have. How will a 5% increase in unit sales affect costs, right? You can't just say, oh, it's only revenue or profit coming in. No, it doesn't work like that. In order to, make money, you have to use money, right? So if you want to make more products, you have to use more money before you sell those actual products. And what happens if costs, or happens to costs, if we add a product line, right? So we go back to previous chapters, and you had those bolts, right? I've got the basic boat and I've got the deluxe boat. Well, at that time, they thought if we added a new product line, things were going to be great. But they ended up not being so great because they were losing money on creating that deluxe boat. So you have to make the right decisions, and you have to know and understand the behavior of cost. So what happens to costs if we increase automation in the production process? Well, that's a good thing. That's making things more efficient, right? We want to increase our automation in order to make the production process more efficient. That lowers our costs, may cut down on our overhead, may cut down on the people that we need to allocate towards this job, and we can have them doing more value-added activities. So in the second lecture, or part two of the lecture, we'll start with this slide. I'll stop right there. So close this one out and then go to chapter 5, lecture part 2.